Hey everyone, this is Mike Bond with the Cash Flow Company. Today we're going to go over the pie and how it affects your lending and how it affects you as an investor. For the last 23 plus years, I've been working with investors, mainly new investors, people who are just starting out trying to figure out how to build income and wealth. The biggest hurdle is learning the lending side. Wealth in real estate investing is created by using other people's money. It's used with leverage, but you have to understand the leverage side, what it looks like. How do you make it work for you? You have to understand what the lender looks through. You understand this, you'll understand how to play the game better and win more. What all lenders are looking for are three things that make up their decision if they're going to lend you, how much they're going to lend you, what loan to value, all those kind of things. Number one is loan to value. How much money do you have in a property? How much equity do you have? What is your piece of this property? It's one of the biggest factors that lenders look at when they're determining if they're going to lend you, how much they're going to lend you, and what it's going to cost. The second is income. Income can come from you or the property. You know, if we're looking at a DSCR or you're looking at a fix and flip and you're going to sell it. So it can be from you, it can be from the property, but it's also another factor. It's income, but it's also what they call reserves. How much money have you put away in case something comes up? If you're buying rental properties, how many months of reserves, how much money do you have in case the property goes unrented for 3 to 6 months? Can you take that and can you cover it? And if you're a flipper, how do you make those payments? How do you make those payments for the next 6 to 9 months? How do you make those HOA, everything like that? So it's income, but part of that is how much have you saved in reserves? Last is what everyone loves, and that's your credit. What is your credit score? How have you paid people in the past? This is a big determining factor. More and more money is being lent based on algorithms and computers and everything else like that. So it's a factor of your credit, your loan to value, and your income. So now let's look at a couple examples because it's not always equal. Every deal is not always the same loan to value, the same income, the same credit. What factors are more important when lenders are looking at you as a borrower and how much they're going to lend you? So number one is loan to value. Of course, the lower the loan to value, which means the more money you have into the property, the more they're going to be flexible maybe on your income or even your credit. So if you have a property that you're into it for 90%, they're going to be very diligent on exactly making sure you hit the income and you hit the credit requirements. But let's say on the loan to value, you have a 60% property. You've owned a rental for a long time and you're just refinancing it. When your loan to value is lower, they can maybe overlook, maybe stretch their DTI or lower their credit scores. Just another factor as we go through this and we talk about this, remember when you take away, which means maybe your credit or your loan to value is not the perfect piece of the pie, you may have to compensate that by a higher rate. So when we're looking at this, take into account that yes, with a lower loan to value, you could have a lower credit score and maybe lower income, but the other determining factor, the offset to that for the lender may be a little bit higher in the income too. Our goal here is to make sure you understand this, you use this so you pay the least amount as you're investing, because that's where you create more wealth and income when you pay less on the money you're borrowing. So number two is income. Does your personal income make the payments or can it make the payments on this new debt? The more income you have to cover the expenses, the more they can look at higher loan to values or maybe lower credit. Or on the other side, if you have more reserves, maybe you have a big 401k, because 401ks, IRAs, all of those things, anything that's liquid, which is like a stock, a bond, savings, anything else like that, is what's in reserves. So the bigger your reserves, the more they can look at maybe giving you a higher loan to value. Or if your credit is not all the way into the 7s or 800s. Income from the property also, the more the income from the property. What does that mean? Let's say your expenses are $1,000, your mortgage payment, your HOA payments, your flood insurance taxes and insurance payments. Maybe those equal $1,000. If this property is bringing in $3,000, the lenders are going to be a little more flexible on your credit and your LTV because they know that this property is going to be able to sustain, even if the market goes down a little bit, those kind of payments. Now let's look at if it's $1,000 in expenses, but we're only bringing in like $1,100. So if the property goes vacant for a month, goes vacant for a couple months, maybe the market shifts, the lenders are going to look at that as like the income is a little less sufficient to take any kind of hits or damage. So they may be tighter, meaning they want lower loan to values. They may want to make sure your credit scores are all the way up. It's always a mix. They're always mixing where they can go because everyone fits, everyone's pie is just a little bit different when lenders are looking. Not everything is just computer-based. You go in with like I said, a lower loan to value, they're going to require less on your income for verification. Your credit is good, your loan to value is low. Guess what? They may care less on checking everything on your income. Lenders will give you breaks if you give them a little bit more on the loan to value, the credit, or the income. When you open up or expand one of these, they could shrink one of the other requirements and make it easier for you. So now just a reminder, we're doing all this just so you understand how lenders look at it, because you have to understand the lender's perspective so you could understand when you're out there looking for leverage, monies to buy these properties. Last, everyone's favorite is credit. What is your credit score? I'm going to tell you this is probably the most important one here, because if you have a bad credit score, because we see them, let's say someone has a credit score in the 500s, but they have a good property. It doesn't matter for most lenders. You could be at 50 or 60%. I bet you 90% of the lenders would not even look at you because of their requirements of because what they can and cannot do and where they can be flexible. This is one of the places that they can be least flexible based on their requirements, because lenders, your loan officer has guidelines. They have to look at certain things. So if you have a sub 600 credit score, even a sub 620 credit score, you're going to be limited in some of the things that you could do. Loan to values, I've seen it over and over. I've seen people with 500 credit scores looking for 50% out on a property. Guess what? They have one or two choices. Credit is vital when you're looking at these. A higher credit score will get you more money. It'll get you a higher loan to value, and it'll also give you some flexibility on income. If I was going to work on one, especially as a new investor, I would start here and get this as high as you can, because your rates are going to be lower. So if your rates are lower, guess what? Your income does not have to be as high because your payments are going to be lower. The lower the interest rate, the less you're going to pay in a mortgage payment. The less you're going to pay in a mortgage payment, the less income you're going to need. The less you're going to pay on a mortgage, the higher your loan to value can be also. So a lender's going to look at all of these things. The easiest thing to fix or help with is the credit. We've gone over credit. We've gone through credit because this is what it comes down to. This is the easiest for anybody to fix. It's hard to go and prove 2 years of history when you just started 1 year in business. It's hard to put another 20 or 30% down on a property because maybe you don't have it. If you have good credit, you have more doors opening. Everything is a balancing act. Lower credit, maybe lower loan to value, lower income. Better credit, higher loan to values, probably less income. Lower loan to values, some of these can be tweaked a little, but it's always a balancing act. It's not just one thing that lenders look at. If I'm starting in real estate or in real estate, the one thing I'm going to focus on is credit. I want this to be as high as possible. And it's probably the easiest thing to do, like I've said before, but I'm going to make sure that I'm watching this, maintaining this, keeping every business expense I can on business credit, on business lines of credit, whatever it be, all of those off your personal credit report, because the more things that get on your personal credit report, the lower your score can go. The lower your score is going to impact your rate, which is going to impact your incomes because you're going to need more income because your rate just went up. That may impact your loan to value. We're going to focus a lot when we go through different videos on your credit because it's easy for everyone to work on. Simple things, making sure you pay on time, making sure you separate business and personal. All of those things will impact your overall leverage. Your overall leverage is where you create the wealth, where you create the income, basically out of thin air. You find a good valued property. You use someone else's money, like in a BRRRR strategy or fix and flip, and you create the wealth, you create the income. But to make it easier for you on the leverage side, you need to understand this pie, everything that goes into it. And we're going to focus a lot on helping people on the credit side. So our goal here, once again, is to make sure you're as successful as possible. And we can't really help you put more money down. We can't give everyone money to put down on the loan to value. And we can't help you increase your income unless you're doing some of these things and creating more properties and creating more rental income. But everyone could work on their credit. Everyone could do simple things to create a better credit score. A better credit score, of course, gets you lower rates. Lower rates means you don't have to have as much income. And it also can increase the loan to values that you're getting on loans, so it helps your leverage. Focusing on your credit is what every investor should start with and keep up with, because it's the easiest thing to do to impact your leverage in real estate investing. I think this creates a great picture of what every real estate investor should understand about the leverage side. It's not just the loan to value, hey, I got a great loan to value, or it's not just the income, hey, I got a great job, but it's all of these pieces put together, with credit probably being the first thing. Once again, leverage is how you create the wealth and income. You need the leverage, you need other people's money. You just don't have to overpay for it. This should help you understand what the lenders are looking at, so you can take this information and now make your life easier, more profitable, and get more deals done. So if you want to put this to work for you, if you want to optimize, you want to make sure your pie is where the lenders are looking for it to be, check out thecashflowcompany.com. We have some great free tools, especially on the credit side. How do you fix it? How do you quickly fix it? How do you move everything to business? Go to thecashflowcompany.com, and we'll see you on the next video.